So see, there are three pillars to our multi-bagger approach to investing. Okay, first and foremost is value. And my personal belief is that if you build a portfolio of value stocks which are spread across various sectors, then there is very low probability that in the long run you're going to make, not make money in the stock markets. You are definitely going to make money in the stock markets. Even something like a CPSE basket has tripled in the last 2.5, 3 years. And the PSUs have more or less underperformed, and yet you could have tripled your money. But people were busy buying, all the popular names like HDFC Bank and so many other financials which have not done anything over the last 2, 3 years, and that's when they became popular. So first and foremost is buy value. Buy value at a significant discount to its intrinsic value. Not just stock market is a place where stocks guided between 20% of intrinsic value to 500% of intrinsic value. So stocks can go 80% below their intrinsic value. So you have to buy it not just at a discount to intrinsic value, but at a significant discount to intrinsic value, right? And then you have to let the story play out till the time, the valuations get frothy. You could buy a stock, say theoretically whose value is 100. You could buy it at 80 rupees, then see the stock price go to 20 rupees, and then sell it back at 120 rupees, and then see the stock price go to 500 rupees. And you would have missed out the entire multi-bagger journey. Right. So as Ben Graham said, the market is manic depressive, and you have to, buy into those manias and depressions within the market. So clearly, that's the first focus for us, buying value. Second, as I said, is growth. Growth is important, but what matters is future growth. Historical growth has got no relevance, right? Historical growth has got no relevance. 2020, the stocks, 2020, 2021, the stocks that you had to buy were the commodity stocks, because that's where the future growth was, which has happened over the last 2 years. You have to buy future growth. You cannot buy. And typically what happens in the market is people look at historical growth and say, wow, these companies have done so well. And these are the companies which will continue to do well over the next 8 to 10 years. So future growth is important, and growth is something that gets rewarded. As earnings grow, P multiples expand. Right? So a multi-bagger is a combination of earnings growth and P expansion. You need both for that. Right? To have a 100 bagger, you cannot have earnings grow up 100x. Very few companies have managed that. So how is it possible? It's possible if the earnings grow at a rate which is higher than what the market expects. And then second is the P expansion. I'll give you an example. We bought Avanti Feeds in 2013. Okay, and at that point in time, we owned close to 4% of the company. The company had a turnover of 300 crores. Its market cap was 90 crores, and their profitability was 30 crores with no debt on the balance sheet. So this was a company which was available at 3 times P multiple. So this was not just a discount, but at a significant discount to intrinsic value. First criteria. Second, if you look at it, if you just open the government of India at that point in time had permitted cultivation of Vannamai shrimps in the country, right? Yeah. And that was a big game changer, because Vannamai shrimps, the produce can be 4x that of the traditional, black tiger prawns. So there was going to be a huge demand as far as shrimp feed was concerned, and this guy was the only player with more than 50% market share as far as shrimp feed is concerned. So growth in their balance sheet, they said that we are expecting 15 to 20% growth for the next 4 to 5 years. It's another thing that they ended up delivering more than 30% top line growth over that next 5 years. Their top line growth was closer to 40-45% CAGR over that period. So second is the growth came in, and third is a contrarian approach. When we invested in Avanti, I told a lot of my friends that, look, this looks very nice. This is the annual report. This is available at 3 times earnings. And nobody was interested in that company. And then people came and said, oh, all these shrimp feed companies that come with IPOs in 92 and everything, and none of them has ever done well. I said, but look at this company. And then from a 90 crore market,
grown by more than 100 times now, as we
see. Yes. So from 90 crore, the market cap eventually went to 16,000 crores. And from a 3P multiple, it went to nearly 60-70 P multiple. And at 60-70p multiple, everybody was gung-ho about the stock. And we quietly exited the stock, and we haven't since bought the stock. So we've all heard that. We've all said that. We've all heard Buffett say that what is popular on Wall Street seldom makes you money. And yet we want to buy the popular names. So the key is do your research, right? Buy low PE, buy a strong balance sheet, focus on future growth, have a contrarian approach to investing, and I'm sure over a period of time you'll make a lot of money. That's a simple motto to investing.